You're listening to The Real Estate Way to Wealth and Freedom podcast, episode 2.
Typical rents, Jacob, in middle America are about, something like $1 per square foot per month. So in other words, an 800 square foot apartment might rent for $800, right? Mm-hmm. We were renting them 13 times that high. We were renting them for 300 square foot, really high-end efficiencies for about $3,900 a month and staying pretty full.
Welcome to the Real Estate Way to Wealth and Freedom podcast with Jacob Ayers, providing actionable content to help you along your journey to financial freedom through real estate investing. As the premier asset class, real estate has helped ordinary people just like you amass fortunes. The benefits of passive income from real estate investing will allow you to live a life you want. And now your host, entrepreneur, real estate investor, and apartment deal syndicator, Jacob Ayers.
Hi, and welcome to the Real Estate Way to Wealth and Freedom podcast. I'm your host, Jacob Ayers. Today, we're going to be talking about finding your niche in real estate investing with the guy who's really done it all. Our guest today is Paul Moore. Paul, after graduating with an engineering degree and then an MBA from Ohio State, started on the management development track at Ford Motor Company in Detroit. After 5 years, he departed to start a staffing company with a partner. They sold it to a publicly traded firm 5 years later. Along the way, Paul was a finalist for Ernst & Young's Michigan Entrepreneur of the Year award 2 straight years. Paul later entered into the real estate sector, where he completed over 85 real estate investments and exits, appeared on an HGTV Special Real Estate episode, rehabbed and managed rental properties, built a number of new homes, developed a waterfront subdivision, and started 2 successful online real estate marketing firms. 3 successful developments, including assisting with the development of a Hyatt hotel and multifamily housing project, led him into this arena. Paul is the author of The Perfect Investment, Create Enduring Wealth from the Historic Shift to Multifamily Housing. Today, I welcome on the show, Paul. Paul, how are you?
Great, Jacob. So glad to be here.
Hey, great. Thanks for coming on. We're excited to have you today. So, Paul, could you tell us a little bit about how you got started in investing and just a little bit about yourself?
Well, so like you said, I sold my company in 1997, and people say that that others with resources, with money, with capital have lots of ways to invest in profitable projects that the general public doesn't have access to. But it's also true, Jacob, that people with means have ways of getting scammed and burned that the general public doesn't hear about either. So I sold my company and I moved to the Blue Ridge Mountains of southwestern Virginia, and we decided to start a nonprofit organization to reach out to international students, which we did. And I also started investing in things I knew nothing about at all and didn't really know the different ways I could get burned. And I invested $100,000 with a guy from Charlotte who had a surefire way of making a 36% annual return. His 36% got him into the federal penitentiary for 153 years, and he still won't tell the 2,000 investors in his thing where he hid the $18 million. Wow. And I invested in another thing, which was like buying someone's retirement out early, one of those deals, and didn't know that the guy could declare bankruptcy and somehow get his money back. So just a couple things like that really were frustrating. So I decided I really wanted to invest on things that I learned and I knew about. So a buddy of mine who needed a job, actually had a lot of skills in home maintenance. We decided to start flipping houses before flipping was a thing and before Chip and Joanna Gaines were around and all that. So we started buying houses on the courthouse steps. The first one we bought for $34,000 and sold it for about $60,000. And we actually only painted it and cleaned it. So we made about $25,000 profit. And I thought, well, we could do this once a week.
Right.
And it seemed really, really exciting until we got our second and third one, which we lost money on. I think the second one for sure, maybe the third one. And so really learned the ropes on that. began investing in basically building modular homes. Built a stick-built home, which was a big mistake. Developed a subdivision, and started flipping waterfront lots. So that's kind of how I got started in it. I also built a real estate team, residential realtors, which I basically have a website. I generate leads for those folks, and still do that 13 years later on the side.
That's awesome. Yeah, you mentioned investing in something you know and understand, and to me, real estate's fairly intuitive, and that's what kind of drew me to it. And, I don't consider myself the smartest guy in the room at all times, and I don't have to reinvent the wheel. As real estate investors, it's easy to look at somebody who has the success you want and kind of mirror their actions and replicate that success. So, yeah, I completely understand transitioning into real estate.
Yeah. Yep. So you've dabbled in flipping and developments and lots of different things. How did you finally settle on your current niche, and could you talk a little bit about that? Sure. So
I say dabbled lightly, by the way. There's no dabbling when you're flipping 85 homes, but
well, the truth is I was dabbling because my partner did all the hard work. I mostly provided the financing, the acquisitions, and marketing. They let me paint a closet once, but I think they went back behind me and redid it. So anyway, I started investing in oil and gas, which I thought I knew something about because I had a petroleum engineering degree. And we invested in North Dakota during the oil boom, the other, oil boom, not the one that you're in. They're in Texas, South
Right.
Texas. But we found my partner had a small jet, and every time he would go to North Dakota to check out the oil and gas thing we were involved in, he found out he had no place to stay, and he found that a lot of people were sleeping in their trucks and their cars and in flimsy RVs by the road in this miserable North Dakota winter. And so we were both involved in real estate, so we decided, well, let's build a multifamily facility. We didn't even call it that. We just called a place for these guys to stay. And so we built a really, really high-end, nice place that people could come home to after their, 12 or 14-hour work days. And we rented it. Typical rents, Jacob, in middle America are about, something like $1 per square foot per month. So in other words, an 800 square foot apartment might rent for $800, right? Mm-hmm. We were renting them 13 times that high. We were renting them for 300 square foot, really high-end efficiencies for about $3,900 a month and staying pretty full.
That is crazy.
So, yeah, so we kind of sensed that it was getting overheated, so we sold it while oil was still like $95 a barrel. We sold at the height of the oil boom. We were so happy we sold when we did. We made a lot of money. But later, I really looked at it more carefully and thought, that was really, really risky. I mean, the people that bought it from us, they took a bath, I think. And so decided that there might be a better way to own apartments and started looking into Class B value add multifamily, which is what I'm doing now. And so the way I got into that is I was already in my 50s, and I thought, I didn't want to take 10 or 20 years to learn this. So I basically hired a mentor, paid a good deal of money, brought on a partner to split that. And we are being, I shouldn't say are, we were being mentored, and we are still in relationship with this company who's way ahead of us in this area, way smarter than us, has done a whole lot of deals. In fact, they've done a lot of deals in your area in Houston. And so basically, they got us started, and that's how I got involved in Class B value add multifamily, which is what I wrote the book about.
Yeah, great. So what areas of the country are you focusing on with your Class B multifamilies, or are you?
Yeah, so we feel like about 2/3 of the success in any project is based on the market you choose and the property manager. And so we make market selection the top priority. We are looking to invest in markets that have a lot of population growth. They call it net population migration, low unemployment, a diverse economy, not dependent on one, industry. Basically, a high propensity to rent versus own. basically something that's basically in a sub-market that's pretty much doesn't have a lot of open land, a place where there's where there's not going to be a lot of apartments built right around us. And so we're looking for markets like that, and those would be like Houston, San Antonio, Dallas. We would say Austin, but it's so overheated now with California people coming in that we really don't want to compete there. We don't want to overpay for anything. Denver and some of the coastal cities are the same way. We wouldn't do that. We like Tennessee. We like Chattanooga, Knoxville, and Nashville. We like the I-85 corridor from Raleigh-Durham, North Carolina, down to Charlotte, down to Greenville, South Carolina, Atlanta, and then on down around Birmingham as well. So that's the areas we really like.
Yeah, great. It sounds like you put a large emphasis on the demographics of the market before deciding to invest there, and I think that's the fundamental basis of it, right? So,
yeah, very true.
Okay, so could you talk a little bit about your current projects and what you have going on right now?
Yeah, so we have spent a long time trying to, wanting to ensure we didn't overpay for a project. One of the problems with our strategy is that we are choosing cities like Charlotte or Houston that a lot of other people like too, for the same reasons. So we're competing against a lot of people. Some of them have cash, more than we do. Some of them are willing to go hard. That means put a hard deposit down, a non-refundable deposit right up day one, right up front day one.
Yeah.
So we've bid on a lot of projects, but we just basically had a stopping point. We said, we're not going to pay more than X. And so we weren't willing to. And so we have not won most of the projects we have bid on. And I think a lot of people in the space feel that way right now. Now, we could compromise and go to a city that we didn't like as much, or we could buy a much smaller asset that we thought didn't have the economies of scale, but we haven't done that. And so what we're working on right now is a multifamily project in Chattanooga. It's got 196 units, and we're hoping to close on that by July of 2017.
Yeah, and for our listeners that are thinking those far out dates, you have to realize that when you're closing on these multifamily deals, the due diligence periods are a lot of times much longer than your smaller deals. There's a lot of things you have to go in and analyze and confirm, right? So that's why your dates are so far out like that.
Yeah, typically to get from a letter of intent to a contract might be 3 weeks, and then about 30 days for due diligence, and then 30 more days to be approved for the loan and close.
Right. Yeah, okay. And so could you talk a little bit about some of your better deals you've had and some of your bad deals you've had in the past and how you've kind of overcome those bad deals? Yeah,
so I'm really big on market selection, and one of the reasons is the Hyatt Hotel that a partner and I built. He put the money up and he ran it, but I helped him. I actually helped him select the site. I helped him connect with Hyatt as a franchise. I helped him in a lot of ways. That actually was in a market that I wouldn't choose again. And so that had a lot of things against it. First of all, we were building in the middle of a North Dakota winter, which was not planned, but the general contractor went bankrupt in the middle of the project. They had about $1 million or $1.5 million from us that we had already paid them to pay the subs, and found out later that they hadn't paid the subs. We went in, even though the law stated we didn't have to, we went ahead and paid those subs and kept them on the job. But it meant we had to go through the worst and coldest winter, from what we heard, in North Dakota in at least 50 years. And so we built that way over budget because of the general contractor snafu, the winter, etc. And then we found out that some of the things that were supposed to happen in that neighborhood didn't. Some of the other retail developments and commercial developments did not come about. And so what I learned from that is, number one, bad market, because it was dependent on oil and gas. It was in a different part of North Dakota, but it was still somewhat dependent on oil and gas. Second, we made some bad choices with a general contractor. Third, we believed things that were going to happen, and we were optimistic about what was going to happen around us in the neighborhood, but it didn't happen. And that's one of the things I think is so important, and that is to base your decisions based on what's already in place, not what could happen, because what could happen, as you know, doesn't always happen. So that was certainly one of our worst deals.
Yeah, I like to, when I'm looking at properties and underwriting them, I always consider the worst case scenario. And if you can live with that, then the upside is just the cherry on the top, right? So you can't really hope for any kind of projections or appreciation or things like that always.
Right. Very true.
Okay. And how about a good story, a really good deal you've had in your past, and what'd that look like?
A good deal. Well, there's been a lot of those. I think the one that I mentioned earlier, the multifamily we built when we didn't even know the term multifamily all those years ago. We just wanted to find a great place for oil workers to live. That just everything about that. Almost everything just went perfect. Timing was right, location was right, construction was right. The revenues were fantastic. The resale was great. That's probably my favorite deal in the real estate realm, at least.
Yeah, right. So you've started out. You've developed some properties. You've had experiences with developing hotels for Hyatt, and you've come across into multifamily. What do the differences and just the fundamental investing differences look like from developing and managing those types of properties to multifamilies?
Well, I want to specifically drill down even further and say, what are the differences between development deals and finding an existing deal? I tell you, if you want to be really wealthy, be a developer. And if you want to be broke and go back to delivering pizzas, then be a developer, because I tell you, some of the most successful, incredibly successful people in the world, like Donald Trump, are developers, and they're developing from the ground up. They're taking all those risks, but there's so many risks, and so I would say, that for me in my 50s, and with my desire to give my investors a safe investment and my family a safe investment, then I really like buying an existing property that's maybe worn or tired or mismanaged or needs to be upgraded, and it's already performing at a decent level, and then try to make it great. And I think that's a lot lower risk than development. So in this case, that's what we're doing. We're buying existing, like 1980s apartments, and we're upgrading those, as opposed to what we did before, which was bring a hotel out of the ground with all the uncertainty and all the things that went wrong with that. I really like this model better for me. Now, we won't make $10 million profit on an apartment building or an apartment asset like we could have on the hotel when we brought it out of the ground, but we're also not going to lose $10 million, which is closer to the truth with the Hyatt. Right.
Yeah, so it boils down to your risk profile and the difference between developing and investing in multifamilies.
Mm-hmm. That's right.
Right. Okay, so could you talk a little bit about the partnerships you have and how you're currently structuring those on your deals now? Sure. So the team we have now has three very different types of folks in Wellings Capital, our company. One of our partners is from Dallas, and he is the founder and chairman of the 7th or 8th largest property management company in America, specifically in the space of HOA, POA, condo management. Okay.
And he considers himself a tech entrepreneur. He's a Harvard MBA. He's written case studies for Harvard. He's spoken around the world about entrepreneurship and raising capital. And he's just really good. He'd be great to have on your show, by the way. But he's really good at vision casting and getting a vision for what something could be, dreaming big, raising money at a higher level. He doesn't want to work on raising $100,000. He wants to go for somebody, who can invest $30 million. That's the kind of guy he is. And So he's a big thinker, but he's also very good on details. He developed like a 700-page spreadsheet, like 700 different sheets that are all linked together. It's crazy, but
Wow.
it's called small business. Well, anyway, you can find it at wadetmyers.com. That's WADETMYERS.com. I think it's Small Business Startup Analyzer or something like that. But anyway, and then I got another partner who's really good on the building and maintenance and construction side, which I'm not. And so he's actually, he owns a couple pain management clinics. He's a doctor, and he's looking to get out of being a doctor like a lot of them are because of all the regulations and paperwork now. And so he is great for just kind of the long haul, just, trotting along. I'm more in the middle, I'm more in the, I'm better at starting something, getting it up and running, getting the new apartment, getting the new investors, and then moving on to the next thing, which is more my thing. So that's our team.
That's great. Sounds like you guys have a good dynamic, and it's obviously working for you. Now, Are you guys the only 3 investors, or are you raising money from other passive investors?
No, we're raising money from passive investors as well. The syndication model that we're using allows us to be involved in a whole lot more deals because we're bringing in other investors into the deal.
Right. Okay. Well, great. Well, sounds like you guys are having a lot of success and buying right properties. What does the future look like for you and Wellings Capital?
So we're looking to acquire 2 or 3 or 4 assets per year for the next couple of years. And then we plan to start a fund and begin to acquire larger deals like portfolios. We've heard about off-market portfolios that could have been great deals. And we haven't moved on those. And we think that the fund structure would be the way to go for that. And so I would love to see us have a couple thousand doors under management within 3 years, and then go from there to much higher heights at that point. And hoping that the market might have cooled off just a little bit, and it might be easier to find assets at reasonable prices too.
Yeah, great. And for our listeners that don't understand what that off-market portfolio is, could you talk a little bit about what that means?
Sure. So it's most assets come up for sale through a bid process, which means that a commercial broker will put together a big package. They call it an OM, or an offering memorandum, and they show that to potential investors, potential syndicator buyers. And they bid, and people just put in their bids. They write letters of intent. And then the highest bidder doesn't always win, but the highest bids are usually evaluated further through a questionnaire and things like that. And then they choose the bidder that they believe has both a good price and the highest likelihood of closing in a timely way. However, off-market deals would be something where there's no bidding process. Maybe a broker or the owner themselves shops it around, if you will, to a handful of potential buyers, and they sell it without taking it through the offering memorandum and bid process. And the goal for a lot of buyers of commercial assets would be to find opportunities like that, where you don't have to bid against a dozen other people and fight to, and end up paying a little more than you want to.
Right. Okay, great. Well, Paul, you're rocking along. You guys are going to be hopefully acquiring 2, 3, 4 properties over the next few years, and then getting into off-market portfolios. Mm-hmm. At the end of the day, why are you doing this? What are your reasons why? I know you're passionate about a few things. Could you tell us, what drives you and what keeps you going, and why you're doing all this?
Yeah, well, so I really want to develop even though it's not really passive for us as a syndicator, more of a passive wealth generation model. I tell you, I wish I would have done this a lot of years ago because I love what I'm doing and I love what we can do for investors. But I want to do that for the sake of my family. But I don't know, Jacob, if you've heard about the horrors of human trafficking, but if you take the record profits the record year profits from Apple, Nike, Starbucks, and General Motors, combine that together, multiply it by 2, that's the approximate annual revenue generated by human trafficking. We're talking, yeah.
That's astounding.
It is. We're talking modern day slavery here. And what they're doing is horrible. It affects 21 million people. That's like the combined total population of Pennsylvania and Virginia together. And so we, all the partners in Wellings Capital, have made money and are making money in other ventures. Like I mentioned, my residential real estate website. We are passionate to generate a whole lot of profits to fight human trafficking and to rescue its victims. We we know that there are places. I visited a place, a 300-acre farm in Missouri just a few weeks ago, where they are bringing these girls and some of them children from all corners of the U.S., and they're basically telling them, "You have hope. You're not a piece of junk. You're not a piece of me. And they're basically giving these people hope and a future, and that's what we want to be involved in, and that's what I really want to give a lot of the rest of my life to doing.
Well, that's great you're doing that, Paul. It's such an honor for you to have the ability to do that and give back. And you're right. I mean, at the end of the day, you guys are making plenty of money. You're fine, and you've got your basic needs taken care of. And the fact that you guys are all three in a partnership together and agreeing on this great cause is it's something else. And I really applaud you guys for doing that. That's great.
Oh, thank you.
Well, Paul, are there any other things that are driving you, keeping you waking up in the mornings and putting one foot in forward of the other?
I mean, that's I really believe we were created for a purpose, Jacob, and I really feel like I used to think there was I had these different buckets of my life. I thought that there was a bucket for work, and then there was a bucket for my family and my faith, and then there was another bucket for anything like nonprofit I wanted to be involved in.
Yeah.
And what I've realized is that's all. It's really there's really no difference between all these things, and a lot of people have, when they get in their 40s, 50s, or even their 60s, they go through this thing called integration, I guess you could call it, and it's a place where you realize that a lot of the pieces of your life, which you thought were separate, are all integrated, and you really come to a place where you realize, wait a minute, this all fits together. I see why I did that, why I learned that, why I failed at this. And we bring all these things together, and that's what I feel like I'm doing now. And that's exciting because I don't feel like there's a really big difference now between my faith and also my work, because I feel like it's all part of the same big vision for my life. So I love that.
Yeah, that's great, Paul. I think sometimes you got to take a step back and figure out how all those things play together, and probably something I could work on myself, because I do feel like sometimes my life's broken up into segments. You've got your work, your personal interest, your hobbies, your religion, things like that. So yeah, being able to take a step back and see how all those things play together is very important.
Right. Yeah, that's true.
Okay, Paul, as we're wrapping up, we've got the last final lightning round, just a series of questions we'll hit you with and just kind of shoot from the hip. So how's that sound?
Sounds great. Let's do it.
Okay. Starting off, what was your biggest hurdle getting started in real estate investing, and how did you overcome it?
For me, it was my lack of knowledge about construction, and I knew a lot about marketing. I knew, I had some finances available, but my lack of knowledge of construction and all the details. I was trying to be a single-family home builder with those modular homes and the stick-built home, but I didn't know how to hang a doorknob. And so it allowed contractors, once we brought in more than just the few I knew well, it allowed the new ones to really take advantage of us, of me. And so that was the biggest hurdle, I think.
Right. Okay. Do you have a personal habit that contributes to your success?
Yeah, I do. So I'm a really fast-paced person. I'm running really fast, really hard from, it would be from the moment I roll out of bed till I roll into bed at night. Do you roll into bed? I guess you do. But anyway, but I actually take about an hour every morning to sit quietly, to meditate, to pray, to basically just get myself really centered and to connect with God for the day. And that's my favorite habit that I do. And I don't always see the direct benefit, but often later in the day, things will happen that I wouldn't have expected. And so I really do see the benefit of that. And it's been great.
Awesome. Okay, do you have an online resource that you find valuable?
Yeah, I've always wanted to get I always wanted a CRM. I always wanted a contact management system. And for years I fought it. I mean, I wanted one, but then I wouldn't use it. Then I had scrap paper, and then I had an Excel sheet that I didn't use very, very well. Well, my tech partner, Wade, has got me involved in HubSpot over the last year, and I've really enjoyed it. It's been a great contact management tool. It's the basic version is free, and the upgraded versions are quite expensive, actually, but the basic version is very usable and doable, and I use that to stay in touch with friends and other contacts in the business and investors.
Great. You said that's HubSpot?
Yes, HubSpot.com.
All right, cool. All right, what book would you recommend to the listeners and why?
I have different books at different times when I'm on podcasts, and today I'm going to recommend the book called Pitch Anything by Oren Klaff. That's OrenKlaff. It's called Pitch Anything, and though I wouldn't agree with every single thing in the book, he does a phenomenal job of laying out the neuroscience behind the way we react to each other, and the importance of not being desperate or needy, or the importance of basically just, kind of playing it cool when you're talking to brokers or investors or something like that. Not to be, going out and looking desperate, and just how to position yourself for who you really want to be in the first place, which is somebody who is not crawling and begging, but somebody who is self-confident and who is able to present themselves in a way that would be attractive, so to speak. And so that's, Pitch Anything is a great book.
Sounds like a great skill for a syndicator.
Yeah, it really does.
Okay, great. Okay, if you were to give advice to your 20-year-old self to get started in real estate investing, what would it be?
I think that, plain and simple for me, I'm sure that I would tell myself to get involved in multifamily, commercial real estate, commercial multifamily, and syndication as early as I could. My son's 23 and my assistant is 24, and I tell them, guys, if you can get involved in this at a young age, the amount of good you're going to be able to do in the world and the amount of wealth you'll be able to distribute and accumulate is incredible. So that's honestly my greatest advice I would give myself at 20.
Okay, great. Well, Paul, as we're wrapping up here, I'm sure our guest would like to contact you or know how to contact you. So you have your book coming out, or it's already out, I'm sorry. It's The Perfect Investment, Create Enduring Wealth from Historic Shift to Multifamily Housing. And then you also have a podcast, right? And it's called How to Lose Money, which is a very unique title. You might have to explain a little bit more about the show.
Yeah, it's a wealth building podcast, I'm always quick to say, called How to Lose Money. Basically, anybody who's an entrepreneur, investor, or successful person, they have had things done to them, or missteps they've made, or failures or mistakes that have cost them either money, or a business, or relationships, or a lot of time. And because of that, we thought it would be great to, instead of just getting on a podcast and just talking about our successes, wouldn't it be great to interview really successful people and let them talk about some of their mistakes and failures? And so that's what How to Lose Money is about. We've been doing that for a while, and we've really enjoyed talking to a lot of great people.
That's great. That's a very unique perspective and something that's valuable to everyone. I try to always ask the guests, some of your worst deals so that you can kind of learn from those people's mistakes, and it's the premise of your show. So great.
Right. Yeah, thanks.
Okay, Paul. So Wellings Capital, that's wellingscapital.com is where our guest can find you. Is that correct?
Yeah, they can email us at info@wellingscapital.com, or just put a contact form through our website, or they can find my book, The Perfect Investment, on Amazon.
Great. All right, Paul. Well, we certainly appreciate having you on the show today, and thank you for your time.
You bet, Jacob. Thank you so much. It's an honor, and I really appreciate the opportunity. Have a great day.
Absolutely. Thank you, Paul. All right, that wraps up our interview today with Paul Moore. As you can see, Paul is an extremely experienced guy and brings a tremendous amount of value to the table in his partnerships and his investments. If you'd like to learn more about the resources mentioned in today's show, please visit www.jacobayers.com/podcast. And as always, if you'd like to reach out to me, feel free to reach me at www.jacobayers.com. I invite you to subscribe to this show and be notified of all future episodes. And if you enjoyed today's show, please leave me a rating and review in iTunes. Thank you.
You've been listening to the Real Estate Way to Wealth and Freedom podcast, providing you actionable content to build your real estate empire. Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for personal advice. The opinions of guests are their own. Information is not guaranteed. All investment strategies have a potential for profit or loss. The host is operating on behalf of the Real Estate Way to Wealth and Freedom, LLC, exclusively.